Most people hear the word options and immediately think risky, complicated, maybe a little dangerous. And fair enough, options can be risky. Some option strategies can lose more than you first expect, and a few can expose traders to very large losses. But the basic idea is not mysterious. An option is a contract. It has an asset, a price, a deadline, and a cost. Once you understand those four parts, every strategy in this course gets much easier. Let's build one from scratch. Imagine a fictional stock named XYZ. Today, XYZ trades at $100 per share. An option contract might say, for the next 30 days, someone has the right to buy or sell XYZ at a fixed price. That fixed price is called the strike price. The deadline is called the expiration date, and the cost of the contract is called the premium. If an option costs $3, that usually means $3 per share. Since standard equity options usually control 100 shares, the contract would cost about $300 before commissions and fees. This is the most important beginner distinction. The option buyer has a right. The option seller may have an obligation. If you buy an option, you paid for a choice. You can use the contract if it helps you, or let it expire if it does not. If you sell an option, you collected premium up front. In exchange, you may be required to take the other side if the buyer uses their right. That trade-off is the heart of options. Buyers pay for flexibility. Sellers collect premium but accept obligations. There are two main types of options: calls and puts. A call option gives the buyer the right to buy the underlying asset at the strike price before expiration. So if you buy a 100 strike call on XYZ, you have the right to buy XYZ at 100 during the life of that option. Why might that matter? If XYZ rises to 120, the right to buy at 100 can become valuable. But if XYZ stays below 100, that right may not help much. You would not usually want to use a contract to buy something at 100 if the market price is lower. A put option works in the other direction. A put gives the buyer the right to sell the underlying asset at the strike price before expiration. If you buy a 100 strike put on XYZ, you have the right to sell XYZ at 100. If XYZ falls to 80, the right to sell at 100 can become valuable. If XYZ stays above 100, that right may not help much, because you could sell at a better price in the market. Now we can map the four basic option positions. If you buy a call, you have the right to buy. If you sell a call, you may have the obligation to sell. If you buy a put, you have the right to sell. If you sell a put, you may have the obligation to buy. This grid matters because a lot of beginner confusion comes from mixing up the option type with the action. Call does not automatically mean bullish in every context. Put does not automatically mean bearish in every context. Buying and selling change the risk completely. Let's use a simple example. XYZ is trading at 100. A 105 call costs $2. A 95 put costs $1.50. If someone buys the 105 call, they are paying for the right to buy XYZ at 105. If someone buys the 95 put, they are paying for the right to sell XYZ at 95. Neither contract guarantees a profit. The call buyer needs the stock to move up enough, soon enough to overcome the premium. The put buyer needs the stock to move down enough, soon enough to overcome the premium. That phrase, enough and soon enough, is one of the big ideas in options. When you buy stock, the main question is, where does the stock go? When you buy an option, that question is still important, but it is not the only question. Options also care about time. They care about volatility. They care about how far the strike is from the stock price. They care about the premium you paid. That is why a stock can move in the direction you expected, and an option can still disappoint you. This is not a bug. It is how the contract works. Before we get into strategies, I want this course to start with the right habit. Every option trade begins with risk. Not the dream outcome, not the profit screenshot. Risk. Ask, what is the most I can lose? Do I have an obligation? When does the contract expire? What has to happen for this trade to work? If those questions feel annoying, good. They are supposed to slow you down. Options reward precision. They punish vague hope. So what is an option really? It is a contract based on an underlying asset. It has a strike price. It has an expiration date. It has a premium. Calls give buyers the right to buy. Puts give buyers the right to sell. Buyers pay for rights. Sellers collect premium and may accept obligations. If you understand that, you already have the foundation for every strategy we will cover later. In the next lesson, we will slow down on calls and puts and make the 4 basic positions feel automatic.